This is John Paulamy of the Actionable Intelligence Alert. Today is Saturday, October 13th, 2018, and here's my weekly market update. So, not too much uranium news, but what I think is a pretty good indicator. We have another entity coming public that's going to be taking additional physical uranium off the market. And the name of this company is Uranium Trading Corporation, and they are in the midst of conducting an initial public offering. They were founded just back here in June of 2018, and like I said, according to the offering documents, they are looking to raise $50 million, and they will be buying approximately 2 million pounds of uranium. That will be their initial takedown of uranium. Don't know a whole bunch about this company. I intend on doing some more research, but just wanted to get it out there that they are in fact taking physical uranium off the market. Don't know who they're getting it from. They are getting it at, according to the prospectus, at a 1.5% discount to the market. But I think it's significant because we've talked about this. I've talked about this quite a bit in the past, that we would see more investment dollars coming into the market. And I think, you know, as some kind of institutional money wants to come in, it's not necessarily going to go into the junior uranium stocks that you see being discussed on Twitter. It's more than likely going to go into the physical market, and that at least has some liquidity and certainty about pricing, i.e. we are substantially below the cost of production. So I think that you know, with a current market cap of the entire industry being around $8 billion for all the stocks, and I think a half of that's probably Cameco, you know, until this market really gets moving, I think you're going to see more and more of the professional and institutional money going into physical uranium via these participation vehicles, i.e. Uranium Participation, Yellowcake, and now this Uranium Trading Corporation. One of the things I wanted to point out, which I thought was interesting this last couple weeks, is as we've had this market correction, we've seen some of the stocks, especially some of the juniors, uranium juniors, come off substantially. I kind of want to remind people that uranium stocks are still stocks, and if we have a general market downturn, I'm not talking about a crash, I'm just talking about a bear market, we could see these markets or these uranium stocks be affected. When people's greed or fear of missing out turns to fear of loss, there's a tendency sometimes, especially among the more unsophisticated, to just hit the sell button on the bid. And as liquidity dries up, prices have a tendency to drop fairly quickly. So considering that we are in a uranium bull market, I think it's going to be irrespective of what happens in the general overall economy. I mean, the lights certainly aren't going to go out. Even there's no recessions or even depressions that I'm aware of in the West where even the lights went out. But so we do see uranium continuing. The price of uranium will go up over time. However, there will be quite a bit of volatility in the uranium stocks. And I think for people that really understand what's going on, these are opportunities to buy additional shares when the uninitiated or the bleacher bums are selling because they're scared and they're in and out of the market. So I think we're going to see more of this, especially as the Federal Reserve continues to tighten interest rate or raise rates. Liquidity will tighten. They are withdrawing liquidity every month, and eventually I think that we will have a bear market in the United States in stocks. This could affect even uranium stocks, but like I said, the overall general market in uranium will not be affected. The demand is there. It will continue to be there. It will continue to grow. Not with anything to do with the overall economy. So another thing is this week that I thought was pretty good, Mike Alkin, who we all know, was interviewed by Palisade Radio in a two-part interview. I will post the links in the comment section or the information section of the video. Pretty much, if you've been around uranium, he talked about a lot of things that we kind of already know about. but he did get into some depth about a few things. And if you are looking for a education or want to become further informed or educated on the uranium market, I'm not just talking about physical uranium, but I'm talking about the enrichment and the fuel cycle, then these are excellent videos. And I think that this guy has done more research and made it more freely available than anyone out in the market regarding uranium. So I'll put the links there. I suggest you listen to him if you haven't listened already. You may have to listen to him twice because he does get pretty in-depth, and you may not understand all the concepts or terms. I suggest that you take some notes and look the stuff up on Google. Okay, getting into some oil news. So big news this week was offshore driller Ensco and Rowan agreed to merge. I think this is excellent. This is what you want to see at the bottoms of markets, what you want to see as bombed out markets or industries are getting close to a turnaround. You want to see consolidation, and I think that's what we're going to see. We're going to see the offshore drilling sector, I believe, consolidate down to 3 or 4 big players. We'll then see the retirement and scrapping of quite a few of the older rigs that are no longer serviceable, and that will help to cement in this industry revival, which I think is happening. I'm not going to get in depth into this merger, but Rowan brings an excellent balance sheet, an excellent complementary heavy weather jackup rigs, and a contract with the Saudi government that's pretty lucrative. Obviously, Ensco already had a merger prior to this, and a lot of people didn't really like that merger with Atwood, but I think this continued consolidation of the industry is wise. Oil prices are now at a sufficient level where we're seeing record cash flows from quite a few of these large international oil companies, and I suspect that as we listen to some of the conference calls in the next couple quarters, we'll see a loosening of the purse strings, because international oil companies, of course, are in the business of finding and exploring for and producing oil. And depletion is always in effect, and they want to continue to grow. So if they can make the numbers work and they have the cash flow, their boards will instruct the management teams to deploy funds into new exploration. So we expect to see the continuing repair and how should we say, a recovery in the offshore oil industry and the oil services industry in general. One of the things I want to talk about here, this is a quick little free trading opportunity. This is for people that are interested in doing short to medium term trade. This is not investment advice. I'm just pointing this out. Something that I'm doing. I'm putting this trade on Monday. There has been a huge collapse in the price of crude oil that is produced in Western Canadian Sedimentary Basin and in the oil sands of Alberta. So the reason why this is severalfold. First of all, long term, the Canadian government has just been completely stupid in not building sufficient pipeline capacity to take these resources out of the country, whether to the coast in British Columbia for export to Asia, or increase pipelines to the U.S. to bring down to the Gulf Coast refineries. It's just pure stupidity in politics. So that's finally caught up. That's led to an overall differential that's averaged about $18 to $20 a barrel between Western Canadian Select and WTI, which is West Texas Intermediate. So it's usually averages about $18 to $20 a barrel, something in that neighborhood. What has happened recently is that we're in the shoulder season, where we have left the the summer driving season and are going through the fall and entering the winter season. So refineries take this opportunity as demand for products decreases to do what's called turnarounds. And turnarounds are done in refineries over about either between 2 to 4 weeks, 6 weeks, where they take down the units, do repairs, do upgrades, do maintenance, whatever. When you're in turnaround, obviously you're not producing at full capacity, so your demand for crude oil to turn into refined products goes down. This has been exacerbated by the natural gas issue that happened with Enbridge and some of the refineries in Washington. So we have this overall confluence of temporary events, which has caused the differential between these two crude prices to go from a typical $20 spread to a $50 spread. We've seen the price of WCS, the Canadian crude price, collapse to like the high $20 range. You can buy it for like $28 a barrel. I believe this is a temporary phenomenon. When the turnarounds are over, crude will start flowing in those refineries again. We also see that there's a new refinery right outside of Edmonton that's ramping up. It does nothing but take heavy crude from the oil sands. And we also have been tracking and seeing more crude by rail. That's kind of limited right now just by the amount of personnel and rail cars, tank cars, and engines available to transport the crude. So long story short, there's an opportunity to see a temporary anomaly in the pricing differential correct itself over the next few months. So I think the way to play this, the way I'm playing it, is there is a Canadian crude ETF. It's called CCX, is the symbol. Trades in Toronto. So you'll need to trade it on a foreign with Interactive Brokers or Fidelity's international desk. But I want you to check out the chart. You can see right here, in October, the crude price started collapsing, or late September. That's right around where the turnaround season starts. So we've had this temporary set of circumstances come into play in this market that's blown out the differential, and I suspect that you'll see that. You see the tremendous volume over the last couple weeks, but the big waterfall drop. I think that's going to correct itself. You'll see it slowly recover over the next few months. So I'm going to be putting this position on. This is something that we could easily make 25, 30, 40, 50% return possibly over the next couple months. This is not a recommendation. It's just something I'm doing. So you might want to take a look at it. And I keep talking about agriculture occasionally, and recent Goring and Rosenzweig, my go-to guys for commodity analysis of supply and demand and markets. Interesting blog this week about agriculture. My title, of course, it's, nobody cares about it. It's unloved. No one talks about it. It's unknown. But I've been looking at it now for about the last 6 months, and I'm convinced that we are going to see a change in perceptions towards food and agriculture, not just in the short term, but in the medium and long term. And let me just go ahead and quote what was in the recent blog here from GNR. It says, global grain markets continue to be on a knife's edge. Because of extremely strong grain demand, any drop in record global grain yields will have huge impacts on global grain inventories, which are already drawing relative to historical seasonal levels. While today's headlines are dominated by trade war rhetoric, these issues will ultimately have little lasting impact on the bullish long-term emerging market protein demand trends. So they go on to say in their blog that global soybean demand is growing at over 5% annual rates. I mean, that's tremendous. I mean, you're talking about doubling every, divided into 72, 6, 7, global grain demand doubling every 7 or 8 years. Simply not going to happen. We just cannot raise yields. And as I've pointed out in the past, the amount of per capita acreage is decreasing over time. So we're getting less acreage under cultivation, but a rising population with rising demand for protein, i.e. beef, pork, and chicken, which results in higher grain demand to raise those animals. So at some point, this is going to be a problem. Couple this with the fact that we've had 4 years of extraordinarily good weather and growing conditions. And that's a trend that's not going to continue either. We are going to eventually see crop failures. We will see weather issues. My thesis, of course, is not by fire, but by ice. The Earth is actually going to be cooling over the next decades. This is going to exacerbate the previous details that I just articulated. So expect higher food prices going forward. It's just not in the news right now. So the way to play this, in my view, I'm still trying to figure this out. I do have some farming stocks that I hold in Ukraine, but I think some fertilizer stocks are obviously kind of maybe a possibility, and some specialty land holdings that grow food, not necessarily grain, but other types of food stuff. So definitely we'll be taking a look at more of those in the future. But you know, the trade war rhetoric with China. I mean, China's not has raised tariffs on soybeans. So what has happened? I mean, soybeans and oil and these commodities are all fungible. So the Chinese go down to Brazil, clear out the Brazilian soybeans, and now the Brazilians are talking about having to import soybeans from the United States. So you have these, you know, you see it on the news because for, you know, the liberal media, well, the rhetoric with China and the trade war is hurting U.S. farmers, but it might be with a lag because, you know, there's only so many soybeans in the world, and if the Chinese buy out all the Brazilian beans, and then Brazil and other people have to go to the U.S. and buy their beans. So it's just a time lag in my view. But last quote from that article, and I'll put a link to that blog because I think it's interesting. Over the last 4 years, China corn demand has grown by over 5% a year and is now estimated to have reached 249 million tons, far outstripping estimated supply of 220 million tons. So the Chinese are net corn importers, obviously, because of the pork demand and the need to feed these animals to supply their pork demand in the country. I think that over time, this is just going to get worse, and it presents an excellent opportunity for those that recognize the math and what's really going on. So that's it for this week, guys. Appreciate the support. Keep those subscriptions coming, as far as hit that bell and subscribe to the, want to get over 1,000 subscribers to the videos. It would be good. So if you enjoy watching my videos, there's no need to search. Just hit subscribe, hit the bell, and you'll be notified when a new video hits. I do plan on doing another video on the financials and the dissecting of the 10K and 10Q of a company that has really been getting a lot of attention on Twitter, and that's Western Uranium and Vanadium. A lot of discussion, and when you look at the 10K and 10Q, kind of concerning. So look for that this week. I'm working on that. The UEC review was well received. I really didn't get as much hate mail as I thought about it. A lot of people appreciated the in-depth dissection of the 10Q and the 10K. I will do that with Western Uranium, and I will also be doing that with some other of these companies. I do this not to take a giant crap on them. Like I said, I am agnostic towards them and their managements. But when I see a lot of hype on the internet, I want to make sure that we really know what we're buying when we're buying these things. So look for that this week, and I continue to ask for your support, and you guys have given it to me. I thank you for it, and we'll talk to you next week.